Okay, let's talk about candlesticks. Candlesticks at the right context or right time of the market are invaluable for identifying what's happened. Understand that the candlestick is the footprint of the market maker behavior. It's your job to identify the market condition. Candles in the wrong market condition, to me and to this group, are meaningless. Certain candlesticks can be expected at the high and low of the day, and they are as follows. Spike candles, hammers, inverted hammers. Spinning tops, doji types, railroad tracks, high test, low test candles. Now, I'm not talking about gasoline and the cheap gasoline. Okay, I'm going to illustrate every one for you. I haven't left you hanging yet, have I? Okay, here we go. The vector candles. This is a term that engineers like to use. Zaim coined it and donated it to the group. Some people like it, some people hate it, but nevertheless, it just means a candle of magnitude, length, and direction out of nowhere. It's like when you sit back and look at the chart and you go, that don't look right. It just came out of nowhere. Big spike out of nowhere. 3 candles out of the box. That doesn't look right, man. Something's wrong. We know the chart should be a slow, steady rise or a slow, steady fall, but if we get 3 burst candles or a burst in price, something's wrong. The burst in price can come in one push, all inside of one candle. It can come in 3 candles, it can come in 2 candles, it can come in 22 candles. I'm going to draw it for you. Okay? The retail traders have been taught that this is called momentum candles, and they couldn't be more wrong. This is the candle that you say, oh, momentum in the marketplace, and gets you to chase the break or the wrong direction. It's simply an anomaly on the chart that would look like a breakout. It's like, oh man, that's breaking out of nowhere, it's moving. That's a vector candle. And it appears for no reason other than to get things moving tonight. Market maker comes on duty, and he's like, all right, how are we going to start this off tonight? Let's hit the stops low and rise. Vector 3 times to the low, bam, gotcha. The vector candles usually form the low or high of the day on the first leg of the reversal. Now, if it's a V bottom, obviously it's going to be just the first part of the V. But on a W, it's going to be the first leg of the W to form that. It's going to be the first leg of the M. Here's what vector looks like. Okay, what you do is, I told you, always measure the initial low of the day, because that's what these guys are counting. This is your break. This is your first candle to pierce the low, the initial low of the day, right? It doesn't say I love you. It's the initial low of the day. The first candle that pierces the initial low of the day is to get things rolling, to start the stops, to trigger the stops, to get the traders to take, right? Then what do? He spikes it. He hangs around for 30 minutes or so. He pushes it and breaks the low again. Hangs around for an extra 15, and then taps it out to finish by breaking the low again. I'm going to illustrate this for you in a minute, nice and clean. I'm going to talk about the blue box. Yes, just absorb the concepts right now, my friend. All right? The 1, 2, 3 to the low is the vector pushes an extension of the low or the high. All right, let's look at it from the high side. Here it is again. An extension of the high. Steve, I only see 2 candles there. I understand. 1, 2 pushes can be contained inside of here, and the third push can be contained inside of here. But I promise you, measure this. This is, anyone want to take a stab at it? 25 to 50 pips above the initial high of the day, depending on the pair that it came from. Okay? Now, that would be an M top. Absolutely correct. Look, spike to the high, pull back, hit it again, just take it out barely, close below, and then shift it away to trap everyone up in here long. and then game over. Sorry about your luck. Okay? M top. Notice how you have a big outside bar that eats the whole structure up, and these bars trade inside and then shift away. Very important to note. V1 on the chart is not the same as Vector 1. Absolutely not. Vector is only to understand the speed and the movement of the stop hunt candles. Vector, let me see if I can clear this up. Vector identifies stop hunt candles. V1 is a stop hunt low rise. V2 is stop hunt low rise. Right? A1 is stop hunt high drop. A2 is stop hunt high drop. All right? See if I got that right. I know you guys are telling me it's going on in other pairs right now, but I don't want to talk about it. I want to focus on the material. Okay, look, this is very important. Candles represent, candles, bars, whatever, where price has been. When the candle paints and closes, the damage is done. Market makers got what they needed. So when they issue a pin, right? Think about this for a minute. Okay, I've been talking about this. Everyone keeps asking me, what is a pin? When you see the pin, when the pin is issued, the money is grabbed all in here. Because after all, this was a solid candle that started out like this, right? And then what did they do? They closed it like this. And the pin's issued. When the pin is issued, they've got the money. So you have to ask yourself, okay, the pin's been issued towards the high. They came out of the box, 50 pip channel. They cut it in 3 swipes. They ran that candle straight up and pulled it all the way back and snapped it back and closed way below the high. The damage is done. They grabbed the money they needed. That's what you have to understand. Okay, now let's go over the high-low board and understand how they extend the high or low. I made an example of how they extend the high. Okay? Here's what happens, okay? We know that they will extend the high in 25 to 50 pip increments. The activity takes 30 to 90 minutes when the high is reached. Okay? So here's what happens. The initial high is 61.60 sometime between 1 and 4 a.m. New York time, Eastern. The times vary because they don't want you to figure it out. The initial high was 61.60. Craig's group should easily pick this stuff up. 61.60 is breached immediately with an aggressive move, and there's a little bit of a pullback in here. Okay, 1, 2, 3. The initial high is extended from 61.60 to 61.84. 24 points. Okay? They quickly pick up the contracts and get out of that area. Price would drop down to like 61.70, 10, 15 pips off the high. So if you're watching the board, you'll see the number change from 61.60, and in the blink of an eye, it'll swipe 20, 25 pips. Depends on the pair. In the GBP pairs, the first swipe out of the box is about 25 pips. They make the one swipe out of the box about 25 pips if they know they're going for a 50 pip stop hunt. Think about it. If it's in 3 swipes, we got to break the 50 pips down divided by 3 into 3 swipes, right? The swipes are not equal. The swipes are a trick. Part of the psychology of 3. So how do they do that? They'll make the first break 10 or 15 pips. On this example, I'm sorry, I did 24 pips. 10 or 15 pips, right? They'll hit it quickly. Bam, 10 or 15 pips right out of the box. Gets the ball rolling, gets everybody excited. They'll pull back and they'll hit it again. If they did 15, they're going to do about 8 on the next hit. Then on the very last piece up in here, they will tap it 3 to 5 pips. The 3 to 5 pips plus the spread is just enough to annoy the shit out of you and take your money away on the stops. And it's just enough to pick up the pendings if they're structured on the other side. Okay? Now, they quickly pull away 10 to 15 pips off of that number, the new high of the day. Right? You have your initial high of the day, 61.84 becomes the high of the day now. They pull back. Immediately 15 pips to trap the long holders and to evaluate and see what they got. They turn around and make the second pass from 61.70 right back to maybe 78. With the spread, it's 81. Not quite to 84. Why? If they go to 84, 85, it releases the traders. So they'll hold right around 78. Right up in here. The traders that are long here are still stuck, and they're doing the, oh, I got it, baby, it's going, it's going, it's going, and hold on. It comes in as a near miss of the high. Now, variation on that could be the pin goes above 84 and comes right back down and closes here as a hammer on the second leg. But they'll hold a number at 78 by 81, 78 by 80, 78 by 81, 82. You'll see it. If they're working the spread widens and it becomes 78 by 86, 78 by 87, but the 78 doesn't move. That's a hold. The sell side is open, trying to pick up the orders. That action traps the retail traders, gets them to fall for the crap and validate their patterns that they've seen in the textbook. Okay, so now, sometime between 1 and 4 a.m., they're going to break out of the box. Let's say our bias is short. Let's say we have peak formation here, and they come in, consolidate. They had 3 levels of drop. 1, 2, 3. We expect the same behavior tomorrow. They come out. They issue vector candles. Understand this swipe can be one big fat railroad track and then fall back like this in 2 moves. There's your entry, or there's your entry. It can just be 2 big fat candles straight up, one straight down. It's variations on the theme that you have to understand. The job is to get the traders to fall for it. That's why it's mixed all the time. It's disguised as different things. So now, if you're watching the big board, the high goes from 61.60, all of a sudden you'll see it blink. Bam, they hit it. It goes to like 61.72. Bam, they hit it again, 61.80. And then they tap it 4 or 5 pips for the last time 61.84, the high is formed. They quickly get off of there and drop down to 61.70. Traders that don't know anybody go long here on the pullback. They go back towards the high but fail to break the high of 61.84. They perhaps open the spread and go 78 by 85, 78 by 86, but the high holds. Identified by the way the candle closes, it ends in a hammer or ends in a spike or a pin. They then shift the zone away from the higher level traders. Our entry is here. Around 61.78, 61.75 with the spread, you grab yourself a nice position. 61.74 would give you a 10 pip range to the top of the formation. Add a few pips for good measure for the stop. I'll talk about that. There's your entry. Stop loss is right here outside the range. We'll talk about this. Still, stop loss. Just understand that's where it goes. Okay? When the high of the day holds after the things that you need to see are there, okay, let's see. Let's back up now, okay? 5 p.m. Do I got to do this? 5 p.m. high-low reset. Boom, boom, boom. Trade in the range. Widen the spread. Between 1 and 4 a.m., you have your vector times 3. 1 push, 2 push, 3 pushes to form the high of the day. Same for the low of the day. It can be 1 candle straight up in 15 minutes, an aggressive move towards the stops. It could be in 3 candles. It could be in 7 candles. When they do it in multiple candles, this is how they do it. They'll go up, break the high, trade sideways within it. Hang out there, hit it again. And then maybe tap it again. And then reverse. Same thing. The only difference is they added 45 minutes in the middle to piss you off, confuse you, because they were accumulating contracts and seeing what happened. Okay? They could do the second candle, not take out the high. Let's say this candle was like this, and then trade inside here, and then hit it one more time. The last tap is always mild. The last tap is always mild before they make the reversal. Why? Just enough to not spend any more money than they have to, but to pick up the stops and grab the orders on the other side. Understand, there's some type of money sitting right here, right? So when they come back in, they just go up there like this and grab it and turn right back around. And they say, sorry about your day. They really don't even, not that polite. They don't even say that. But that's how they grab the orders. Now, you get the revert. Our entrance is here. They shift the zone in 1 bar, 15-minute, nice 15-minute drop. All these traders in this structure are jammed now for the cycle. When they shift the zone in a big 25-pip move, that causes the panic, the lift the stops, the quick turn on the news. Where's CNBC? Let me kick my dog. I can't believe I'm down again. That causes all those emotions and behaviors, and it makes you start to think irrationally. Okay, that's where and how they handle that to make retail traders do that stuff. To make the bad decisions, to lift their stop loss, to do stupid things with their equity. And the bottom line is they end up pocketing it. That's their job. If you understand this is coming, then your job is to wait for this structure to develop and trade it. If you understand the second pass is coming, then your job is to have the perseverance and the patience to wait for the second pass and trade the second pass. I can tell you that if you become proficient identifying the M's and W's and wait for the second pass, you will be 10 out of 10 for the week. The discipline lies in waiting for that, and I can't teach you that. I can teach you what to look for and how to see it. I can't teach you to sit on your hands until it develops. I can't teach you to be patient until that triggers. That's on you. I can show you exactly what these guys do, like a roadmap to success. It's up to you if you get on the path and follow it. I want that for all of you. Once you understand and start seeing this stuff, you can literally telegraph what these guys are going to do and project the market, and you look like a crystal ball guru.